This is kind of a bearish formation. Maybe we see gold.
Would it be back above 62 in silver, or 65 or 70, something like that?
The dollar may just trade sideways for a while. The stock market rallies. And, you look at this little pause here and you're like, oh, that looks pretty bearish. If it starts to break down, we got another leg. This is kind of where I feel like gold and silver are kind of right here. The trends are down. It's pausing right here. And I do think we're going to see most likely silver potentially move higher. The thing with a 50-day moving average is we need 50 days of higher pricing on average for it to start to turn up. So if you want to forget that and look at momentum and pure price action, what I look for is a impulse move. And I see a huge, strong move in precious metals. It takes a bit of a breather and a pause. And then obviously if it starts to run and break out again, then you're going to have that second measured move. If you can just ignore the fundamentals, and the fiat currencies usually will fail over time. Obviously, we've had a very sharp pullback recently with the Fed and the yen and all that causing a very sharp pullback. I don't look too much into headline news driven moves.
Let's start with gold. And I remember sharing this then with people on my side at TF Metals Report about, we were following in 24 and 25 this pretty consistent pattern. You were helping us out with this, these Fibonacci extensions and going up to that 618 level. And if you got through 618, you were going the full way. And man, did that ever work like crazy on the upside? Well, my concern after talking to you last month was that it was going to work out on the downside. We're holding support near that level, if I remember right. But give us an update. What do you see now with a whole another month's worth of daily candles on that chart?
Yeah, I mean, in a nutshell, the long-term trend is down. All the other moving averages are down. We've seen a drop, a bounce, a drop. This is kind of a bearish formation. Maybe we see gold. As I mentioned, the dollar may just trade sideways for a while. The stock market rallies. We might see gold and silver and miners, work themselves higher. But I still think it is a pause at that point, before it potentially starts to sell off in a bigger way. And that's what we need to be aware of. And silver's doing the same thing. I mean, a good example of this, Craig, is actually like Bitcoin. If we were to look at the Bitcoin chart and, just go to these patterns, like, for example, the hard right edge, you have a sell-off, it pauses, and then it sells off, and it has another pause.
Markets may feel stable today, but false recoveries have destroyed more wealth than outright crashes. Chris Vermeulen notes the repeated drop bounce pattern remains technically intact, yet many investors mistake temporary relief for renewed strength. Institutions often wait for confirmation while retail rushes into every rebound, creating liquidity for smarter money. Protecting capital sometimes means refusing the most comfortable narrative. Next, Chris Vermeulen exposes why today's support level could become tomorrow's biggest psychological trap.
And, you look at this little pause here and you're like, oh, that looks pretty bearish. If it starts to break down, we got another leg. And this is kind of where I feel like, kind of gold and silver are kind of right here. It's been a little pause. But what can happen is that pause can continue to trade sideways, and it can drift itself right back up to a previous low. And when you step back and look at the big picture, you got a leg down, you've got a pause. You got a leg down, you've got a pause. And while this can be a rally, it's still a counter trend rally. The bear market is still in place. And eventually it'll run into resistance and then roll over. And so I think very similar for gold and silver and Bitcoin and miners is we might still see these drift higher, but it doesn't actually mean it's starting a new bull market. So if we were to look at silver, silver is kind of doing the same type of thing. It's the trends are down. It's pausing right here. And I do think we're going to see most likely silver, miners, and gold potentially move higher while the stock market rallies over the next few weeks or couple of months. But it's going to be what happens after that. Like how is this price action going to unfold? We really want to see some bullish price action. Ideally, we want to see strong rally, some type of pause and consolidation, another rally. We really want to see the moving averages start to turn up. And we don't really want to see a drift sideways because usually they fizzle out. So that's kind of what I'm keeping my eye on.
Wall Street celebrates every bounce. Yet history shows many begin inside declining trends rather than new bull markets. According to Chris Vermeulen, Sideways trading often disguises weakening momentum before the next decisive move appears. That directly challenges the popular belief that every recovery deserves aggressive buying. Investors who confuse patience with missed opportunity frequently discover they were financing institutional exits. Next, Chris Vermeulen unravels the chart signal separating genuine accumulation from another deceptive rebound.
Yeah.
Would there be are there easily identifiable levels that you could say, okay, yeah, this is looking better? Would it be back above 62 in silver, or 65 or 70, something like that? Is there a level, like I said, you want to wait until you see the trend change before getting in? Is there something you can just jump out at you that says, okay, this is where I would be looking?
Well, yeah. I mean, if you want to negate the moving like the thing with a 50-day moving average is we need 50 days of higher pricing on average for it to start to turn up. So, I mean, it's going to take a while, right? If you want to forget that and look at momentum and pure price action, what I look for is a impulse move. And an impulse move is generally, I find two very clean, significant highs. So this is a fairly significant high, and this one is another significant high. And so ideally what I would want to see, you could argue this is a significant high, but I like to use very, very clean ones. What you want to see is a very strong rally that breaks through 1 and 2. If you can bust through 2 resistance levels, usually that first pause and pullback can be bought. And if it is a very strong move, it actually will turn the moving averages up fairly quickly if it breaks those levels, because prices has moved significantly higher. So the 20-day will turn up very quickly. The 5-day will be above that. The 50-day can turn up and start sloping higher. So that's that would be like the best case scenario. We see a huge strong move in precious metals. It takes a bit of a breather and a pause. And then obviously if it starts to run and break out again, then you're going to have that second measured move. And then, then we could be right back into a full-on bull market and the next big leg higher. So that would be the way that it turns around the quickest.
Yeah. Might take some positive news out of something, the war or monetary policy or something.
Yeah.
To get everybody all agitated and excited again.
Yeah.
Whatever that might be.
The biggest gains rarely begin when headlines finally sound optimistic. What Chris Vermeulen is highlighting is that price must overpower multiple resistance levels before institutions typically commit meaningful capital. Retail investors often buy the story first, while professionals wait for confirmation that momentum has genuinely shifted. That discipline can prevent years of sitting inside stagnant positions. Next, Chris Vermeulen reveals why one breakout matters more than dozens of bullish headlines.
All right. Well, you talk about kind of broadening out the advance, right? That equal weighted S&P and the like. Waiting for some of that cash to get broadened out into the mining sector. Second quarter earnings are generally terrific. And we saw some rally, and some of these stocks look like they're turning higher. I don't know. Well, let's use a GDX or something like that as a proxy. Do you see anything picking up there yet?
Yeah, I mean, on a short-term basis, it's just starting to turn slightly positive. Now, this is the problem with the precious metals space. There's a lot of mixed signals, right? Which makes it difficult. So if we zoom in, what I like to focus on are the moving averages. Really filter out a lot of stuff. It filters out fundamentals, filters out emotions, all of this stuff. So looking at the trends, we got this long-term trend. Technically, gold miners are in a downtrend. They're in the green line moving down and price below it is a bear market. Technically, they're in a bear market. We've got gold miners, the 50-day moving average is sloping down. The pink line, which is the 20-day, is below that. So that is we are still in a very strong downtrend. Now, if we look at this little thin blue line, this is the 5-day. It has crossed above the pink line. So we have a very, very small trend just starting. It's saying, hey, you're a momentum trader. This might have a nice little pop to the upside based on that. Just looking at this chart pattern, we could say, okay.
A short-term rally can quietly become the most expensive trap for long-term investors. Chris Vermeulen's argument suggests miners are flashing mixed signals despite improving earnings, reminding us that price trends matter more than optimistic narratives. Institutions rarely chase the first bounce because false recoveries are common during bear phases. Protecting wealth means demanding stronger confirmation before increasing exposure. Next, Chris Vermeulen exposes why moving averages still disagree with today's bullish excitement.
Well, just based on this chart pattern, here's where this tiny little moving average crossover could carry you, which is about to 80.50, which again, it's not that much upside from where we are. So this bounce in the market in the precious metal space really is just, at this point, is just a bounce within a downtrend. It's easy to get excited and be like, hey, this is the turning point. If you dive in too deep with people who are deeply in love with precious metals, they always put a bullish bias on it, right? People like to listen to what they want to hear. But the reality is this is just a bounce. It's one of these within a downtrend. See, we can't quite trust it yet. The key and where I kind of stand apart from a lot of different traders is I don't really care where I get in. I just don't want to hold something falling, and I don't want to hold something if, for example, it trades sideways for a year or two or three. I'd like to get into it. I'll buy it at a higher price when it breaks out, and then it's starting that run. And so what we need to wait for, the way that I trade anyway, is we need to see gold and silver and miners really pop and breaks a couple previous significant highs, start to build like a launch pad, and show us that these moving averages of the 50-day and the 20-day will start all sloping up, and they'll be layered properly. They'll be like, okay, now we've got potential higher lows. We're going to have like some higher highs, and it's going to be starting this new uptrend.
The strongest investments often begin after investors stop searching for the perfect entry. This is where Chris Vermeulen's thesis shifts from predicting bottoms to demanding proof that trends have genuinely reversed. That approach challenges the emotional urge to buy every dip simply because prices look cheaper. Waiting for confirmation may sacrifice early gains, but often avoids far larger losses. Next, Chris Vermeulen reveals the launch pattern institutions watch before deploying serious capital.
Eventually, I think is going to have some huge gains in precious metals, but we just don't know when that's going to happen. So the precious metal space is turning a little corner as of this week. But again, it's at this point, I really just look at it as a bounce, not the start of a rally.
Well, and if we're going to get the shares to rally, well, then we're going to need the metals to rally too. So we might as well wrap up with those. With something that's kind of in the news here late July and early August, and that's the dollar and the dollar index. It's most folks know it's made up. It's a weighted index, mostly weighted toward the euro, but the yen is in there and the pound and a couple of other fiat currencies. So it's really weighing the dollar versus all this other fiat. Well, part of that index is the yen. And I think most folks have been following the headlines in this new program between the U.S. Department of Treasury and the Bank of Japan to support the yen. So that has had an impact on the dollar index. The dollar index has been having let's call it a negative impact on the precious metals for several months now. So let's start with that dollar index chart, throwing all that fundamental stuff and everything else going on in the world out. What do you see in the chart of the dollar index that could give us a clue as to where it's headed from here?
Yeah, I mean, that's the big thing, right? If you can just ignore the fundamentals, and the fiat currencies usually will fail over time.
Most investors blame headlines, but currencies often reveal the deeper story first. Chris Vermeulen notes short-term optimism in precious metals means little if the dollar's broader trend remains supportive. Media attention follows geopolitical events while institutional money watches currency structure instead. Ignoring that relationship leaves portfolios vulnerable to moves that seem sudden but were technically developing for months. Next, Chris Vermeulen exposes why the dollar may be telling a very different story than gold.
And everything that's going on to potentially cause the dollar to fail long term. If you step back and look at the long-term picture of the dollar, it has come down. It's put in a multi-year kind of basing formation. It's now starting to make higher highs, higher lows. We have the long-term 150-day moving average, which is this green line, which typically, if it is sloping up and all the moving averages are above it, and prices above it, we're typically in a bull market. And so we have seen this happen for a long time. We've seen the dollar put in a bottom, really put in a bottom in January of this year. We saw precious metals put in a peak, and now we're seeing the dollar enter a bull market. And I think that's going to have put a lot of stress or hold, I think, precious metals down to some regard. Now, obviously, we've had a very sharp pullback recently with the Fed and the yen and all that causing a very sharp pullback. But I don't look too much into headline news driven moves. They can create an overreaction. We had a huge volume spike. So, it was definitely a very emotional move and a lot of unwinding. And so now the dollar is trying to find support somewhere down in this, this 99 range. You can see it's had all these highs previously. It's broken through those, and now it's pulling back and it's kind of testing this critical support level. And I think it's just a matter of time, probably, before we start to see it. I think we could see the dollar continue to trade sideways for a while. I don't see the dollar rallying right away.
The biggest risk isn't a falling dollar. It's believing every sharp decline changes the long-term trend. According to Chris Vermeulen, the dollar continues forming higher highs and higher lows despite recent volatility, a pattern that challenges the widespread expectation of an imminent collapse. Headlines can trigger emotional selling, but institutions usually focus on structural support, not daily news cycles. That distinction could determine whether precious metals face another headwind before their next major advance. Next, Chris Vermeulen unravels why the dollar's current support level may contradict the bullish case many investors already accept.
I do think we're seeing the equities market start to shine. It's coming back to life. We've had a pretty broad market rally over the past couple of trading sessions here at the beginning of August. And I think the dollar is going to trade sideways until maybe the stock market starts to stall out. And then we'll probably see the dollar start to pick up speed and break out again while the equities market rolls over. So the dollar here is at support. I think it's going to hold its ground over the next month or two. And I think that's, it's going to probably keep a cap on precious metals. Metals may drift higher, which we'll touch on shortly, but I don't see the dollar breaking down just yet. It really has technically just entered a bull market, and it still has a very strong chart.
So maybe not quite the headwind that it was, but not necessarily a tailwind yet either. You mentioned equities. I think that'd be a fun thing to touch on next. I know when we spoke back in early July, you're like, man, I think there's one maybe not last, but another big rush in U.S. stocks coming here. And over the last 3 or 4 days, oh boy, we've seen as we record this, S&P trading at new all-time highs. Yeah. What do you see? Pick whatever index you want. What do you see in stocks? And as that kind of bleeds over to all risk assets, I think it's kind of important to keep an eye on.
It does. I mean, if the equities market's going higher, we pretty much see almost all stock sectors go higher. And recently we've seen really precious metals rally with equities as well.
Markets are cheering record highs, but leadership shifts often matter more than the headlines themselves. What Chris Vermeulen is highlighting is that a firm dollar and rising equities can temporarily limit upside for precious metals, even while optimism spreads across markets. Institutional capital rotates methodically instead of chasing excitement, creating signals retail investors often recognize too late. Understanding those rotations can be more valuable than predicting the next Fed statement. Next, Chris Vermeulen reveals the market rotation quietly reshaping where institutional money is flowing.
So it's important to understand what the major indices are doing. Now, when we look at the QQQ, which is the NASDAQ 100, we actually just had a cluster of cycle lows come into play here. And, we saw some big flush out, a lot of panic, a lot of people moving out of the space. It's actually very similar to the cluster of cycle lows we had over here. We saw, some big panic selling over here. We saw some big panic selling, very similar style selling. Doesn't mean the market is breaking down. It just means it's correcting. And now we're getting this knee-jerk reaction out of here. And what's interesting, Craig, is the NASDAQ is still pretty far from its highs. When we look at the S&P 500, we have it breaking out to new all-time highs. If we look at equal weighted S&P 500, it's been going the exact opposite. We're seeing the stock market as a whole just moving higher. This is a very strong sign. This is telling us money's pulling out of the big tech and the AI because a big money is starting to think, hey, it's getting volatile, which means it carries more risk. It's in a bit of a bubble phase. It's starting to get some bad news. So we saw money pull out of big tech, and instead of exiting the equities market, it's been rotating into other stocks. It's not like it's running for safety. It's just saying, no, I want to get into some different stocks that aren't quite bubbly and volatile. And so the fact that equal weighted has been moving up is a pretty good sign. And I just mentioned this the other day.
When money leaves market leaders without leaving the market, investors should pay close attention. Chris Vermeulen's argument suggests institutional capital is rotating rather than fleeing, revealing confidence beneath the surface despite weakness in large technology stocks. That contradicts the media narrative that every tech pullback signals broader market trouble. Following capital rotation instead of headlines often protects portfolios from emotional decisions. Next, Chris Vermeulen exposes why equal weight strength may be the market's most overlooked bullish signal.
Like the IWM a couple of days ago looked like it was primed and ready as well. It also had a cluster cycle low. It's starting to pop, and small caps are on the verge of hitting some all-time highs. And so is the micro caps. Micro caps, they're not quite up near the highs, but there's big moves in micro caps telling us people want to put risk on. And going back to your comment there saying from our last conversation that there may be one more big move in the equities market. Well, if we use our Fibonacci extensions based on the upward momentum of this rally, the strength and the momentum of this pullback, it will tell us kind of where these next upside targets are for the QQQ or the NASDAQ 100. You can see just based on where you and I are talking today, which is August 4th, the first target at the 618, which is called the golden ratio, is about an 8% move. And then if it was to rally all the way up to the 100% measured move, it's about an 18%. So there's some pretty good upside there. We have one final maybe blow off phase that you and I had talked about last month, and it could catch a lot of people off guard who are betting on a falling market. Now, I do believe we're going to have a big correction at some point, but we don't trade based on what we think and feel. We just still follow price charts. And so the NASDAQ, depending on the strategy, when we look at our strategy, we've been long with actually has been the QLD, the 2X ETF with our band strategy for a while. It's still holding up. It's up about almost 40% from the entry price. And it continues to show signs that it might go another 40%, if the stock market rallies. So there's some huge potential gains on whether you use leverage or not. The S&P 500 is we've been long that for a while as well. And of course, if we look at the SPY, we actually just hit our first, another target today on it, locking in some gains, reducing some exposure. But we're long the equities market here and expecting it to go higher.
The most dangerous market phase often arrives just before investors become convinced nothing can go wrong. This is where Chris Vermeulen's thesis shifts toward measured upside targets while acknowledging that powerful rallies frequently end with a blow-off move, not immediate collapse. Institutions scale exposure based on probabilities, whereas retail investors often wait for certainty that never comes. Timing matters more than conviction when protecting long-term wealth, the